Hi everyone, I'm Andrew Fox, here with the latest episode of the SPI podcast. I'm here with my co-host Tiago. It's a hot one today, Tiago. How are you dealing with the heat?
Well, I'm comfortable. I have this AC on
Oh yeah.
behind me. So much more comfortable, I think, than you.
I am not dealing with it at all with a beard like this. It doesn't work out. We're here with our guest today, Eric Barthe. Eric, it's been a while since we caught up. How have you been doing?
All right, thank you. I'm also trying to survive through the heat wave, but doing fine so far.
Yeah, wonderful. I think the last time we spoke, we had quite a deep chat about decrement indices, and today's discussion built upon that because it's a slightly different direction. To start off with, how have you been seeing the decrement market going?
Well, I think decrement is still a thing. I mean, especially in the French market, it's still popular. There's still demand for it. So I don't think things have changed too much.
Sure.
Maybe a little bit interest on the single stock decrement. I believe people start to shift. I'm not the data man. Sure. We have the data man in the room. So I believe those single stock decrement now people understood that maybe it's a bit. It can be dangerous. So there's a shift towards, I would say, more thematic indices with decrements. But yes, I mean, I would say given the demand of the French market, right, for long maturities, high coupon, low barriers, naturally you attract this kind of underlying. So that would be my answer.
Let's show some of the data. I mean, SP Intelligence was okay to show some of our numbers, and I think this is interesting, right? This is quite interesting. Is this right? And I think you're right. We had a massive growth. Decrements, we did a webinar last year on decrements, and it's becoming popular not only on France but globally, right? Again, this is sales volume, which is not representative of how much is outstanding on global decrements, but we estimate that beyond, and by end of the year, we should reach to the $40 billion sold. That's 10 times growth from in 6 years ago, right? It's massive. Of course, what you can see is that France is the most significant, followed by US and Canada, which is growing, and you still have these decrements being sold in other countries, in Italy, in Germany. There is a bit in Asia, especially for more thematic. But I think it's definitely a product that it's here to stay. Although the French market has been the most, and I think this is interesting, right? And which I want to talk about is the French market growth, right? It's year on year we're talking about almost 1/3 or 30% of structured products in sold in France have a decrement feature, and we estimate that sold close to 20 billion euros on decrements last year. So quite big, and I think, Eric, you already mentioned about the need, why people are using the decrements in France. So for you, what do you think it's this need? Why in France you have this massive need for these decrement indices?
Yes, I would say, given the structure of the structured product market in France, 80%, those are public numbers. I mean, I'm sure you have those numbers. They were also published by the French regulator. So 80% of the flow is through assurance vie format. So by constructions, those products need to be long dated, right? So in practice, you have 10-year autocallables or even 12-year autocallables. And of course, for the banks to hedge this, it's very illiquid risk, dividend risk for such a long dated, so long tenors. It's very difficult to hedge. Actually, it's impossible to hedge, right? So first thing, the decrements, they sort one of the hedging, one thing. So they make the life of banks easier in that respect. Then the fixed decrement, right, is, let's say, has as a consequence that the payoff is asymmetric. The final distribution, if you want, of the stock is asymmetric. So if it goes down, really, it's really impacted very negatively, and we'll see some examples, I guess, by this fixed nature of the decrement. It means that with a fixed point decrement, structures like autocallable, which do not benefit from the upside, right, and only may suffer from the downside, offer extremely high coupon. because of this, right? Once again, you are rewarded through the coupon for that asymmetry. This is clear. You are rewarded. So it means that typically you can take a stock with a decrement. Usually the decrement is chosen as the last paid dividend. So it's, I would say, all right. It's not an abusively high decrement if you look at it like this. You choose stocks that have some implied volatility that are high enough, and you may offer a 12% coupon per annum, which is obviously extremely high, with a European barrier maturity as low as 30%, right? 30% of initial value. So I would say for 12 years. So optically and autocallable every year, etc. So even with some descending fixture, etc. But overall, this is it. So a double-digit coupon with a barrier that is at 50 or below. So this is quite. It looks safe, right? It looks safe because I would say psychologically a barrier of 50% and below seems safe on whatever it is, right? This is. And also I think recently AMF published a study where they looked at some fees, right? The fees are also important, right? So the decrement allows, I would say, those three things, which is a high coupon, a low barrier, and a fee that is not negligible also.
What would you say is the difference between the market cap and single stock decrement?
Well, I would say obviously the first thing is a diversification. Right? Sure. Of course, when you take a market cap index, you don't have a concentration risk, even though the dynamic is the same, right? Of course, the fixed decrement will impact this index on the downside much more than the upside. So still, this feature is true for indices also. A fixed decrement will pay more than a percentage decrement on indices. This is true. So that's one thing. So if you have a market, even on indices, if you have a bear market, that may go bad, right? But so far we are lucky in a bull market on equities, so it's going well. Also, the maturity is important. Those structures are 10 years, 12 years. So of course, if you take a position on one stock for 10 or 12 years, it's a huge risk. Obviously. I mean, what do you know, right, of the stock in 10 years or 12 years? I mean, I cannot say. Maybe you can. I cannot. If you take an index, at least it has this virtue of auto-renewing itself, right? So by construction, the most successful stocks are the highly weighted stock. The ones that are doing very poorly, they go to the bottom, even are excluded. So you have this, I would say, virtuous auto-regeneration of the index, which is a good thing when you invest in for 10 years or 12 years.
So let's talk about what everyone is talking about in France, which of course, the Stellantis case study. I think, it's been recent on a lot of the newspapers in France, but we all know it's been here. We actually start talking about it almost 2 years ago in 2024, right? Products launched in 2022, 2023, 80 years autocallables. It was a 5%, equivalent to 5% decrement, which was kind of slightly above the dividend. But of course, with what happened with Stellantis, what happens in the US with their US business, cutting dividends, stock plumbing down to, with massive decreases. What's your view, Eric? Why are the newspapers writing about and from your perspective, as the academic wrote about this, is what's your view in terms of this particular case?
Why is they writing about it? I mean, it's a question for them. I believe they realized a little bit late that maybe there was something to highlight.
Yeah.
So I will not try to find explanations about this. But as I said, you are rewarded for a risk that you take, and sometimes the risk actually happens. That's unfortunate, but that happens, right? So Stellantis, so the decrement Stellantis, right? So the modified underlying, if you want, and hence the autocalls on that underlying is doing extremely bad. First, because Stellantis is doing very bad. If the stock was doing well,
no one would care about it, right?
Exactly. And
which, by the way, it's not only Stellantis. The single stock decrement indices has been varied, and we can talk about the new different names, but it's not that we're just only Stellantis.
Yeah. So if you take imagine an investor, right, who would say, okay, despite what I hear in this podcast, I still want to do the single stock decrements. Why not? Right? Because they pay a high coupon for the reasons that we explained, higher volatility than the index, and this asymmetric behavior, more penalty on the downside and less on the upside, but you don't benefit from the upside. So you may imagine an investor still doing this, fine. As long as you put a little bit in Stellantis, but a little bit in Vuitton, a little bit in Total, if you are French, a little bit in Sanofi or whatever. All those stocks. Basically, you diversify your auto calls. So this is a problem. If one single stock is so successful, and I think that's the case of Stellantis. I think it was a very successful commercial. It was a commercial success. The distribution of the Stellantis thing, and now of course it backfired because I guess it's a big. Percentage is a big pocket, oversized versus its weight in the French.
From single stocks, probably 20% of the volume, but overall it's less than 1% of total volume sold in structured products. I think it's actually close to 50 basis points of AUM.
So hopefully it will be as a little share of loss, and that's it, right? I mean, the same as it is for someone who actually buying the CAC, like via whatever an ETF, because now ETFs are very popular. If you buy the CAC, you are unfortunately also suffering from the very poor performance of Stellantis because it's in the CAC still. So it's but of course you've got other stocks. I mean, what I'm saying is obvious, but that applies also to structured products, of course.
What's for you the definition? Do you still think there is value on single stocks, or is this really a problem of the single stock decrement, or is it a problem of the underlyings that are chosen?
No, it's really about understanding. That's it. I mean, as long if you understand what you are doing, it's fine. I have nothing against single stock decrements on the points. They have this behavior, right? That you take some kind of tail risk. You take the risk that the stock loses value quickly, and that's it. Because if it does, you have a zone that you don't want to enter, right? I tried to in the past to kind of draw this zone. Right. If you go there, you are almost stuck, right? Because the mechanism of the decrement means that it cannot really recover because the weight of this decrement every day is so heavy that even if the stock itself, if the company itself is doing well, it has to double every year, right? Just to keep under zero. For instance, I just looked before our meeting. You have a decrement on Stellantis. You can Google; it's totally public. With 134 decrement, and 134 was the real dividend of Stellantis, I think 2 or 3 years ago. So once again, no problem at inception. I would say there is nothing.
Correct.
But now this decremented underlying spot is 3.55, right? 3.55 euros. So it means that this guy is paying almost 50% dividend. So pricing wise, when we price options, this guy is going to zero in 2.5 years, more or less, or because So to keep at the same level, Stellantis needs to take 50% per annum, right? Just for the decrement to stay flat. See, here it's a bit of a trap that is very difficult to escape.
So. And of course, you mentioned about the points, right? Because points are then converted into percentage ultimately, right? That's what you're comparing. And again, we've done this research in the past, and some are over, some are under, some are equal. So it seems to be balanced in terms versus the points decrement versus the realized, or at least especially at inception. But what's your view? What's the added risk versus the of course the coupon also goes up, right? What's the average extra risk you're giving from doing percentage versus points?
I don't have the figures in mind in terms of coupon, but yes, typically here, Stellantis was in percentage, even if it was 10%, right?
It'll always be 10%.
The decrement would be 0.3 and not 1.34, right? It would be 5 times lower. So you don't have this zone of no return. With a fixed point, you have this zone of no return. If you enter it, this is going to zero by construction. And of course, when it goes to zero, this is also the little things, right, that are written in the term sheet. You have an early redemption. So those unless, and I hope for everyone that Stellantis is going to perform miraculously well and is going to double up every year. And if that happens, then the Stellantis decrement may actually do okay. Do actually. If it doesn't happen, right, you may have a Stellantis decrement that touches zero, and at this point, you will have early redemptions at the fair value then. But of course, the fair value then will be probably close to zero.
I think one of the things we saw from the slide that Thiago just had up is that it feels like it's not a single stock decrement problem. It's very much an issue with the sector or the name of the underlying. Do you feel like from your perspective, by seeing a term sheet of a single stock decrement, you can then very easily digest if this is a problem index, problem underlying or not?
At the end, you need to pay a high coupon, have a low barrier, and have a fee that is making everyone happy in the chain. It means that you need a decrement and a high volatility, right? I mean, basically two drivers of the price of the option, which is the driver of your coupon, the put at the end, right? High volatility and high dividends. The high dividend is sorted with the decrement, good. But the high volatility, still, this is something I would say still that belongs to the stock, right? So you need a high volatility stock. A high volatility stock, it means that the decrement on Nestle, for instance, will never pay you a nice coupon. So we need to go for cyclical stocks. That's why you have, I think, in the slide that Thiago showed us, there are many car makers, right?
Yeah.
We have some banks also, but you see, so you need to go for sectors that have a relatively high volatility. So of course, by definition, it means also that they are risky. So you should obviously avoid those sectors if you can, or you diversify. So it means that you have plenty of little autocalls, if you can afford.
Talking about diversification, right? What I've seen recently, it's more, as you said, kind of a diversification on single stocks, but more financial, even thematic indices using decrements, right? And there is the other perspective, which is doing target volatility on specific market caps to get the volatility high, and then the dividend overlay on top of it. What's your view?
So the first one, on the indices, still fixed decrement, and the indices that you understand, in the sense that you have no vol target, right? Here you have also to open the box and to check the composition of the index, because those are actually, they are not indices, they are baskets. Careful, it means that the components of the basket is not going to change.
Change.
It does not have the virtue of the market cap weighted that kicks.
This changes depending on if the market cap goes too down, then it is replaced.
It's out of the index, right? So in a fixed basket, of course, the basket stays the same. So this is important, and you have to check, of course, that you have a fair weighting, that you don't have 2 or 3 components making 50% of the basket, obviously. So that's one thing. But of course, there's some virtue. But still, if you still want with this basket to reach a 12% coupon with a 50% barrier and the fee for everyone, you need a basket that is volatile. So it's not going to be boring stocks, etc. It's going to be punchy stuff, right? And fashionable in 2026. So your product is going to expire in, if you do it now for 10 years, 2036. What is fashionable now may not be fashionable in 10 years. So you see, man, you remember in COVID days, it was Zoom, Moderna, were in the...
And look at those stocks now.
Exactly. So you have to be careful with that. You always, it's in 10 years that we are going to measure the performance. Of course, there is this, it's auto-callable. Of course, there is this game that if it's auto-callable, which is the case, if the basket is up in 1 year, you auto-call and you don't care about this. But still, if you miss it, then you are stuck for many years, which is exactly the Stellantis case. Then to the vol target. So this is different animal. Here, this is this is a dream of a trader, right? Because you remove any parameter risk. You create the so-called Black-Scholes asset, meaning the volatility is almost known in advance, right? And the dividend yield is, which is a decrement in percentage, is known in advance. So this is, for the trading desk, beautiful. It also means, right, happy traders, higher coupon. This is the rule. So if the trading desk is happy, the coupon are also higher, right? This is so because there is no the modeling risk is much lower. But for the investor, it means that you have your underlying is not very clear. If the volatility is high, you have a lower leverage on this guy. If the volatility is low, you will have a high leverage. So it's not very clear. And actually, you cannot tell in advance, right? What will be the performance of this modified underlying, even if you can predict exactly the performance of S&P, let's say, in 10 years. This is, for me, a problem. I mean, you need to be conscious of it.
Yeah. So, and I think it's also important, right, to talk about, because, you know, there's been studies, AMF and other studies have performed. Structured products have been performing extremely well, but of course they looked at the expired and matured products, which, because as you said, it's a bit bullish market, it's been good, and actually these products are not performing, they're not being called. So you have this, still a very small percentage of total AUM that it's underperforming, and you know, it will be kept there according to our data until 2030, where you might realize these losses if Stellantis doesn't recover. But there are other ones, and I think I'll share my screen again, and I think, you know, there is, I think, a lot of single stocks being used, and just focusing on single stocks. The big majority of the market cap indices perform extremely well. The average decrement is very similar to the realized dividend, which is good. People are getting their value, but we have, and I think it's just to give you some stats, we estimate that there is 551 products linked to Stellantis decrements, around 4 billion euros. And when we did this at end of June, that it was at the average level, underlying level of 37%. But there are another one which people are not talking about. It's not as bad as Stellantis, but it's going down slowly, which is of course carrying single stocks, less products, 224, average level 62%. So they're around the knock-in barrier is around 50%. So it's getting closer to the knock-in barrier, but still potential losses, still at the moment at capital at risk. And you can see, of course, we put there a watch list, which is the automobile sector. and even more relevant, as the Chinese just came up with a way that they can get away with a EU tax on carbon, finding out that they can actually make it more eco-friendly cars than the European ones, which will definitely affect the European car maker. So yeah, what's your view, Eric? It's I know I've shared this to you just a few minutes before we record this. So, you know, what's your view on these live products?
No, my view, once again, here this is the performance of the stock that is bad. Yeah. It's not the decrement. Decrement is only magnifying this, right? Yeah. Yes, once again, if you systematically invest your autocallables, your 10-year autocallables or 12-year autocallable in cyclical companies, of course, you may at some point face an issue. Also, just a little point, you know, on the slide just before that you showed, right? So there was this the stocks that pay now a higher dividend than the decrement, etc. I think still we need to acknowledge that in general, right, when the decrement are issued, so when you create a new single stock decrement, you choose the last dividend, right?
Correct.
So usually there is no problem. And of course, if the stock is doing well, you don't really care about this decrement versus the real dividend that the stock is paying, because this is protocol. In that respect, it's very important also not to be biased, because what is the life of the decrement, the life cycle of a decrement index, right? Yeah. It's exactly the contrary of Darwinism, right? Yeah. In Darwinism, the strongest survive and the weakest die. Yeah. For decrement indices, this is exactly the contrary, right? The strongest dies the first, right? A stock that is doing very well will autocall. I mean, the autocall able will autocall. Yeah. And imagine we do today a decrement on stock A that pays an actual dividend of €1. So we do a decrement together, and the stock is doing very well. So in 1 year, it autocalls. Yeah. I am the bank. I'm not going to pay stocks or S&P or all the, I need to now give all the names, Dow Jones, Selective, all those guys, right?
Yeah.
Because this A stock with €1 decrement is not used anymore. But you are happy because you invested in great products, you got your coupon and your money back. So I'm going to look at stock A again, maybe. A is up because you auto-call, right?
Yeah.
And maybe now it's paying 1.2. So I'm going to issue a new decrement, A decrement 1.2.
Yeah.
Right? So the A decrement 1 disappeared.
Yeah.
Right? So the because it was the strongest, it disappeared. On the contrary, if I issue the same stock A with decrement 1, but it was doing very badly, for 10 years you are going to have it in your database as a live product, right? So there is a bias when you look at the live product.
Absolutely.
Tend to choose the weakest.
Yeah, correct.
So just to be fair to the decrement, I mean, some are doing well.
No. And I think I have it here. So the average level versus market cap, percentage, market cap points. And it's interesting, right? Because, of course, percentage issues is around the 5%. That's what's there. And on single stocks, actually, in average, they are doing okay. They are around the initial level. So you can see there, the initial level. Yep. But, of course, as you said, right, you have these Stellantis, these Kerrings coming down, the average decrement that you're getting, that it's still live, right? It's increasing and it's now close to 8.5% because of those that small part of the products, which is also unfair, right? Because the newspapers write, this is the way of it's these products or this whole industry, but it's not a reality. In average, they are performing okay. Yeah, but of course, when you select single stocks, it's all about the specific risk of that company. So,
newspapers, they want to have good stories to tell, so it's normal that they focus on Stellantis. But also, I have to say, it's an interesting use case because it shows exactly how things happen in the worst case. Because Stellantis is a worst case scenario, right? It's a very fast drop of the stock price. And you see all the mechanisms at once. This kind of spiral and this zone that if you reach it, you are stuck. And you can see also the auto calls are quoting at almost zero, even though the stock is not quoting at zero. This is.
So for you, it was a good experience because you could actually prove your.
Well, it was not a good experience, but it was an interesting experience. From a pure, scientific point of view, it's an interesting experience. But I don't wish anyone to lose money on
of course.
Social product.
Do you feel like anything needs to change from a regulatory angle, in disclosure or suitability, just to help downstream?
Well, once again, as long as the investor understands what he's doing, it doesn't mean that if he understands, it's still fine. But this is fine. I'm not sure in the chain everyone was totally aware of this mechanism. Right? And this is what I would say. But from a regulatory point of view, I would say, especially in France, the regulator is already imposing a lot of rules, right, on social products. There is those number of mechanisms that you cannot
go over.
The worst of is not allowed, generally speaking.
Yeah.
And this is why, right?
Yeah.
I mean, I would say this is almost a consequence of this rule of mechanisms that decrements were invented to some extent. This is a way of coping for. I cannot use the worst of. Okay, then I will. At the end, it's about in structuring. It's about lowering the forward and having a high volatility and having a low forward. So if I cannot do the worst of, which lowers the forward, I can also use the decrement, and that's the same job.
Okay. Well, thank you, Eric. I think it was quite good. Especially it was a progress from the episode we did last year on decrements, and I think this really deserves like an episode on it, so people can be educated, right? You need to listen to both sides, see the value, see the risks, right? And I think ultimately that's it, right? It's about disclaimers, it's about the products being sold to the right people.
I agree. Right? I think
Wonderful.
Okay. Thank you, Eric. Thank you, Andrew.
Have a great day. Thank you so much.
Bye-bye.